If you've looked into using your home equity to pay off student loans and the numbers didn't work, there's a good chance you were looking at the wrong rate. Cash out refinances carry a pricing penalty that gets baked right into your quote. Most people feel it, but they never know what it's called. And for a lot of homeowners, that's the number that shuts the conversation down. I'm Wade Betz, Chief Strategy Officer at Empire Financial, and I've run this exact transaction for clients who had already walked away from the idea. What changed the math was a specific Fannie Mae program that removes that pricing penalty entirely, but only if you're using the proceeds to pay off student loan and only if you follow the rules exactly. So here's what the program is, how it works, and what to look at before you decide whether it makes sense for you. Cash out refinances carry a built-in pricing penalty. This program removes it. Let's start with the fee because it's the reason most people walk away from this idea before it gets a fair shot. So when you do a cash out refinance, Fannie Mae applies what's called a loan level price adjustment or an LLPA. It's a surcharge based on your loan to value ratio and your credit score, and it doesn't show up as a clean line item on your closing disclosure. It gets absorbed into your rate or rolled into the cost of the loan, and most borrowers never connect it to a specific charge. I just know the quote came back higher than they expected. So you feel it, but you never see it. The LLPA is essentially a hidden surcharge sitting inside your rate, and the amount it adds depends on how much equity you have and where your credit sits. Here's how this plays out in the real world. Say you have $45,000 in student loans at a 7% rate and you own a home with solid equity. You look into a cash out refinance, your lender sends you a rate, and the math just doesn't pencil out. So you walk away from it. What you may not have known is that a piece of that rate, potentially thousands of dollars, are baked into the cost of the loan. That was the LLPA, not the base rate. The surcharge layered on top of it. The Fannie Mae student loan cash out program removes that surcharge entirely if you qualify, and that's what changes the math on deals that look dead on arrival. How much the waiver is actually worth depends on your loan size, your credit score, and your equity. But that's the mechanism. So what does qualifying actually look like? There's a specific checklist and every item on it has to be met or the waiver goes away. There are 5 requirements and all 5 have to be met. Not most of them, all of them. All right, so here's what Fannie Mae actually requires, and all of these have to be true at the same time. First, and this is non-negotiable, the loan has to go through Desktop Underwriter, DU, which is Fannie Mae's automated underwriting system. DU is the software that reviews your file against Fannie Mae's guidelines, and this program doesn't exist outside of it. So if your lender isn't running it through DU, the waiver doesn't apply regardless of everything else. Think of DU as the gatekeeper. The program lives inside the system, so that's where the transaction has to live too. Second, at least one student loan has to be paid off in full at closing. Not reduced, not paid down, paid off completely. The balance has to hit 0. Partial payments don't count under this program. Third, the money goes directly from the closing table to the student loan servicer. It doesn't come to you first and then get sent to the servicer. The title company sends it straight there. That's a hard requirement. Fourth, at least one borrower on the new loan has to be the person who's actually obligated on the student loan being paid off. You can't use this program to pay off someone else's debt. And fifth, the standard cash out loan to value limit still applies. This program changes the pricing. It doesn't change who qualifies. For a primary residence, that's an 80% loan to value. There's also a cashback limit. You can receive the greater of 1% of the new loan amount or $2,000 back at closing. Anything above that and you're outside the program. Important note here, that does not apply in Texas. In Texas, you are not allowed to get cash back. Now, when you talk to your loan officer, ask 2 things up front. First, confirm they're running it through DU. Second, have them pull the LLPA grid and show you what the waiver is actually worth on your specific numbers. Your loan amount, your credit score, your loan to value. That dollar amount is what you're deciding on. Let it make the call. And that brings us to the part that actually determines whether this is the right move for you, because qualifying and it being the right call are 2 different things. But real quick, if you want to know whether you would even qualify, that same free checklist in the description covers this program too. The requirements in plain English plus documents to gather first. It takes 2 minutes and you will walk into any lender conversation ahead of most borrowers. Okay, now let's find out whether the math actually works. This program changes the cost calculation, but you still have to run your own specific numbers to know whether the trade makes sense. Getting approved for this program isn't the finish line. The question is whether restructuring your debt this way actually works in your favor. A cash out refinance replaces your current mortgage with a new one, so your rate, your term, and your monthly payment all change. The student loan balance goes away, but it gets folded into a larger mortgage. Whether that's a good trade depends on your student loan rate, your current mortgage balance and rate, and how much equity you have and how long you plan to stay in the home. You're not eliminating debt, you're restructuring it. The goal is for the restructured version to cost you less or give you a monthly payment picture that works better than what you're carrying right now. Here's what you're comparing. Right now, you have a mortgage payment and a student loan payment running at the same time. The question is whether one combined mortgage payment with the student loan balance rolled in at the new rate after the LLPA waiver is applied cost you less than both of those payments together. If yes, the trade makes sense. If not, it doesn't, and I'll tell you that straight on the call. Before that conversation is useful, you'll need two things though: your current student loan balance and interest rate, and a rough sense of your home's current value and what you still owe on your mortgage. That's enough to get a real picture in about 15 minutes. If you own a home, you have a student loan, and you want to know whether the student loan cash out refinance actually makes sense for your situation, what the LLPA waiver is worth on your specific numbers, what the payment comparison looks like, and whether this is the right move before you do anything, use the link below to book a call with my team. These conversations are most useful before you've made any decisions, when there's still time to look at all of your options without any pressure. And even if the numbers don't work today, that's still worth knowing because rates move. A no right now can become a yes 6 months from now. You can't know when that window opens if you don't first know what the picture looks like. Once you've run the numbers and decided this makes sense, the next thing to understand is what underwriting actually looks like, because knowing that going in makes the whole process smoother. That video is right here. My goal is to help you make informed decisions with confidence and ultimately win with Wade.